I want to start with a problem that I recently discovered in my own business. At our firm, the whole point of the client relationship is not the numbers. It's the conversation underneath them, what you're building towards, your North Star, what is the real meaning of money in your life. But to have that conversation well, we need information first. The accounts, the documents, the details. And collecting all of that was taking too much of our energy, not because we were missing it, we got it, but it was scattered. Some ahead of time, some during the meeting, some chased down afterward over email and phone calls. It worked, it was just inefficient, and inefficiency has a cost. Every hour me and my team spent tracking down a statement was an hour that wasn't spent on what actually matters. Getting to know the client beyond the numbers, so we can take all that data and apply it to what they actually care about. So my first assumption was that we had a process problem. But when I really looked at it, that wasn't it. The process wasn't the problem. We are a really process-oriented firm. The steps or the workflows, they were all there, written down and clear. The problem was something else entirely. The work was split between me and my staff. And because it was split, no single person owned the finished result. Everyone did their part, and it still came together, just less smoothly than I think it should have. Because owning the entire result was nobody's single job. So we changed one thing. So we put one person in charge of the entire result, not the steps, but the outcome. And it transformed almost overnight. The data started to arrive cleanly and on time, which meant our meetings could finally be about what they were always supposed to be about. Not chasing paper, but the person in front of us. Here is the lesson that I have not been able to stop thinking about. It was never a process problem. It was an ownership problem. Now here is why I am telling you this, because your financial life works exactly the same way. You probably have people, a CPA that does your taxes, an investment firm that runs your portfolio, maybe a banker, maybe an attorney who did your estate documents. Every one of them runs a fine process in their lane. And you might still feel quietly lost. Like everything is handled, but somehow nothing is connected. If that feeling is familiar, I want you to hear this clearly. That feeling is not you being disorganized, it is the exact same problem that I found in my firm. Everybody owns their steps, nobody owns the result. And in my own firm, the cost of that was scattered information and cracks where things could get missed. When it's your financial life, the cost is bigger. It's the tax nobody saw coming, the strategy nobody sequenced, the plan that never actually got built because building it was never anybody's job. And there's a second cost that is harder to see. When no one owns the whole picture, it is easy to get lost in the numbers and miss the entire point. The account balances become the goal and the returns become the scorecard. And the actual question, what is all of this even for, quietly goes unasked. My name is Ethan Ho. I'm a certified financial planner, the founder of Claw Capital Partners here in Hawaii. I help people make sure their whole financial life is actually running together and not just running in pieces. If that is useful for you, hit subscribe and follow along. All right, let's get into it. Let me put this in terms of building a house. When you build a house, you have subcontractors. A plumber, an electrician, a framer, a roofer. Every one of them is skilled. Every one of them does excellent work in their trade. But none of them are responsible for the house. That is the general contractor. The GC doesn't necessarily swing a hammer better than the framer. The GC owns whether the house actually gets built right. They sequence the work, they make the trades talk to each other, they catch the conflict between plumbing and electrical before it becomes a wall they have to tear back open. Your CPA is a subcontractor. Your investment firm is a subcontractor. Your banker is a subcontractor. The question this whole video is about is simple. Who is your general contractor? Let me show you 3 real examples of what happens when nobody is. Someone I spoke with recently is charitably inclined and over 70 and a half, which matters here. They give to a charity directly from their IRA. There is a rule that allows you to do that in a way that is not taxable. It is called a qualified charitable distribution. Done right, a $100,000 gift comes out completely tax-free. And the bonus that's easy to miss, And when you are at the age where the government forces you to take money out of your IRA, whether you need it or not, your RMD, a qualified charitable distribution counts towards that requirement. So you satisfied the forced withdrawal and you don't pay any tax on it because it went to charity. It's one of those elegant tax tools for the charitably inclined. The investment firm processed it correctly, the money went to the charity, but nobody told the CPA it was a charitable distribution. So when tax time came, the CPA saw a $100,000 withdrawal from an IRA and does exactly what a competent CPA does with a withdrawal from the IRA. They reported it as taxable income. So both professionals did their job. The investment firm made the gift, the CPA reported what they could see, and a tax-free gift got taxed anyway. Because the message had to travel from one lane to the other with the client playing telephone, and it died in the gap. A general contractor could have made those two talk to each other directly or at least cleared up the communication. Another example of this, someone recently came in with a clear retirement income objective number. They wanted $12,000 a month in income to retire. If you stop there, that is a math problem. Any advisor should be able to solve it. Here are your assets, here is your withdrawal rate, here is whether the numbers work. But we don't stop there. We start asking why. And the number began to open up. Part of that $12,000 was so they could buy a home for their adult child and carry that mortgage in retirement. And why that? Because they have reason to believe that their child needs extra support, quietly and for many years. And so they want to help and they want to keep them close. And there was more. A rare opportunity had come up to buy the right home in the building that they live in. A window that would not stay open long or forever, and underneath that, even more real fears. They didn't want to compromise their own retirement to do it. They were still unsure of how to draw income from everything that they had built. And here's the part that stays with me. This is a person with a significant net worth, like genuinely wealthy, and yet still quietly worried whether they could afford their own simple life. Now think about that first number, $12,000 a month. A firm that just runs money solves for the number, but the number was never the point. The point was a child, a building, a window of time, a fear about a simple life that the balance sheet says should not exist, but absolutely does. You can't plan any of that if all you're doing is running the portfolio. Owning the house means owning the why underneath the number. This theme is something that I think about a lot. Someone else I spoke with recently had their advisor model Roth conversions for them. The advisor ran the numbers, looked at the lifetime tax savings, and concluded it wasn't worth it. I'll assume that the math was done correctly, but here's what the math missed. This person did not need to save money on their own lifetime taxes. They were gonna be fine. What they actually wanted was to pass more money to their children and to not hand those children a tax bomb, because an inherited retirement account now has to be emptied within 10 years, which often means the kids have to pull money out and pay tax on it during their own peak income earning years at their highest rates. A Roth conversion solves exactly that problem. You pay the tax now at your rate in retirement, and the children inherit that account entirely tax-free. The advisor modeled the conversion off of lifetime tax savings, but that was never the goal. The goal was the kids. Same calculation, but a completely different answer depending on what you were solving for. The advisor did the math, but nobody owned the objective. And I think that is the difference between someone who works in a lane and someone who owns the entire house. Now, I want to make a bigger point about how this whole industry is changing. It used to be that running money well was hard and rare. Picking the investments, running the allocation, rebalancing it over time, that took real skill and real work, and people paid well for it. But technology changed that. Low-cost index funds, modeled portfolios, automatic rebalancing, target allocations you can buy in a single fund. The running of money has become more efficient, more accessible, and frankly, more commoditized than it has ever been. Good returns used to be the scarce thing you paid for. Now for most people, a sensible, low-cost portfolio gets you most of the way there. So here's what I believe. The value of a great advisor is shifting. It has moved away from just running the money and towards owning the whole house, the coordination, the sequencing, the tax strategy, the Hawaii nuance, the actual objective, the general contractor role. And I will be honest with you, a lot of advisors have not made that shift. They still see their job as only running the portfolio, and they do it fine. But fine at running money is no longer the rare thing. Owning the whole house is, and that is the shift that we are building our whole firm around. So I want to describe two people, and one of them could very easily be you. Because the gap I am describing, it shows up in two different ways, and they have two different fixes. One you fix by asking for more, the other you fix by picking up the phone. The first person is someone I've met again and again. Same situation, just different names. They have a well-known firm running their money. $1 million, $2 million, $5 million, and the returns are good. They are genuinely happy with the performance. So when I ask if they have a real plan, a coordinated tax strategy, Hawaii-specific planning, a clear picture of what they're building towards, the answer is usually no. But here's the thing, they don't want to move because the returns are good and they're paying someone who they assume is already doing all of that. This is the trap that I want to name. Good returns become the whole scorecard. Not because returns are the whole job, but because returns are the one thing that is easy to see and easy to measure. The coordination, the planning, the strategy, the objective, those are invisible until something goes wrong. For this person, nobody owns the house, and the fix is to find a person that will. The second person is the opposite. Someone else I spoke with recently actually works with a firm who plays that general contractor role. They coordinate, they plan, they reach out, and they are genuinely trying to do the whole house. But this person was not engaging. The advisor would reach out to schedule the planning conversation, and it would keep not happening. The offer was there, the coordination was available, it was just not being used. I want to be really honest here. Sometimes the gap is not your advisor. Sometimes you are already paying for that general contractor and you are leaving them on the lot with the blueprints rolled up. If that is you, the fix isn't to switch. The fix is to pick up the phone and actually engage the person that you already have. So before you do anything, go to the person who runs your money and ask them to build you a real plan. Not just a performance review or a market update, but a coordinated plan built around you. Some of them will do it and do it beautifully. And if they can do that with returns that you are happy with, honestly, why not have that conversation once a year? I think there is no harm in expecting more than an investment update. And here's the specific thing to listen for. When they build that plan, what question is it answering? Because most of the time, what you'll get is a retirement projection, a probability of success, a green light that says you are on track, that you will not run out of money. Now let me be clear, running out of money is a real fear. Even people who will almost certainly die with money left over, it is one of the most common worries that I hear, and it deserves a real answer. So getting that projection and seeing the green light, that matters. But here's the thing, that is the first checkpoint, not the whole plan. Confirming you're going to be okay is where good planning starts, not where it ends. And too many advisors stop right there. They hand you that green light and they call it a plan. When the real work, it was only just beginning. Because once you know that you're gonna be okay, the questions get better. How do I pass more to my kids and less to the IRS? How do I coordinate taxes across the whole decade? How do I handle the local or Hawaii specific pieces? How do I use this money for what actually matters to me? A green light answers one question, will I be okay? A real plan answers the ones that come after. Here's what I want to leave you with, a simple test that you can run tonight, and the truth that no advisor should ever forget. You own your financial life, not your CPA, not your investment firm, you. Your North Star, your goals, your result. So the real question is not who owns it, the question is who is helping you own it well? Who is the sounding board? Who is helping you see the whole picture? Who is helping you make sure that every piece is actually working towards what you care about? That is what a financial general contractor does. They don't take the house from you, it's your house. They help you build it on purpose. So ask yourself, who's actually helping me own my whole financial life? Name a person, not a firm, a person. If you can name them and they can name your real goals, you are in good shape. Go engage them. And if you can't name anyone, that is the gap and it's worth solving. Not because you're in trouble, you're probably doing fine. But when your situation is sophisticated enough, fine is quietly expensive. Fine is the plan that never got built because it was nobody's job to actually build it. If you guys found this useful, hit subscribe. I keep on putting out practical, Hawaii-specific financial planning content, and I hope you can see it. And if you're sitting there realizing that nobody actually owns your whole financial house, that is exactly the role that we play here at Claw Capital Partners. A discovery call is just a conversation to see if it's a fit. Head to clawcapitalpartners.com to find out, and I will see you in the next one.